Well, we're almost at the end of my guide to financial lingo. In this last section, let's have a look at what sort of transactions and their associated terms you can expect to come across in the world of finance and accounts. Remember in the last video on budgets, I explained about the financial years and how in councils this runs from 1st of April to 31st of March the following year? Well, spending and income relating to what goes on in a financial year doesn't often happen exactly on the same day that the goods and services are provided. Sometimes money has to be spent before the new accounting year on goods or services that won't be used or received until the new accounting year. The accountants call that a prepayment, like that invoice for computer services over there. So 20th of March today, the invoice services won't be used until next financial year. But rather than delay the payment, we can pay it now, and the accountants will ensure that that payment details go into the next financial year and not stay in this year. Oh, sometimes it's the other way round. We get goods and services delivered in one year, but won't receive the invoice till the following year. Look at that cleaning contract employee over there. The cleaning company provide their services now on the 20th of March, but won't send their invoice to them way into May. So the council will make sure that the accounts record an amount in this year's accounts for them services. When the bill comes in May, the original entry, offered an estimate, is taken out and the actual value of the invoice recorded. The accountants call these accruals. Let's have a route round one of them financial cost centres for last financial year. It's the sports centres. See what's been paid or received money-wise. See that filing cabinet? That one's got records of all the money going out recorded in it. Yeah, you guessed it, expenditure. Whereas the cabinet next to it has got all the records of money coming into it. Yep, you guessed it, income. See on the top of each cabinet there's a running total for the total amount spent and the total amount collected. If you take away the income from the expenditure, you get net expenditure. If you just look at the expenditure on its own, it's called gross expenditure. OK, let's open up that expenditure filing cabinet. There's a section inside it for office stationery. Look, what's the first thing I've come across? It's an official order. It's just a list of things or services that you want the supplier to provide you with. Important for two big reasons. Firstly, if you don't write it down in an order and send it to a supplier, then they may send you more or less of what you wanted because they didn't hear you properly, and that can cause a lot of misunderstandings. Second, when you type up an order in the finance computer system, it immediately puts a little marker against that financial code you're using to tell anyone else, and you, if you forget, that you've already effectively spent some of your dosh. It's called a commitment. Quite often, you have to put an estimated cost against the item or services because you don't know the exact figure. If that's the case, when you finally pay the supplier, the account software just takes out the commitment and writes in the actual amount paid. If you didn't have commitments, then there could be all sorts of problems with people spending money that had already been set aside to pay for something that's on order. Makes budget monitoring much easier. Tell you what, I haven't even mentioned revenue expenditure yet, have I? It's really important to accountants too. Look, if we spend money on buying something that's expected to be used within an accounting year or shortly afterwards, then it's classed as an item of revenue expenditure. Look, there's a few examples. Fuel, and that stationery we saw earlier on. What happens if we're going to use things that we buy for longer than a year though? Well, look over there. We can see a few examples of what's called capital expenditure. We got computers, vehicles, buildings. This type of expenditure, known as capital assets, have a use beyond the end of the financial year. That could be 2 years for a little computer, to 50 years or more for a building like an industrial unit. All depends how long you expect the asset to last. If we didn't have capital expenditure, we'd have to record all the expenditure in 1 year, and that wouldn't allow for a fair comparison of 1 year to the next, would it? If we use something over many years, we'd expect a little bit of its cost to be recorded in the years that it's used. Now that really helps to explain what an asset is generally. Something that's useful or of value to the organisation. Like debtors. These are people or organisations that owe us money. Look, there's a sundry debtor. This is someone who owes us money, and that must be useful for us. All sundry means is miscellaneous. Well, the opposite side of things to assets is liabilities. Whereas the assets are what the council uses to deliver its services, liabilities represents what the organisation owes to lenders and suppliers that have provided the loans or services and goods without yet having been paid. They're known as current liabilities. We call them creditors around here. We owe them for something they've done or delivered, like the stationery supplier earlier. Now them current liabilities or creditors are short term. What we've also got are long time liabilities. Look, like loans from the bank. Now, what have I missed? Oh yeah, journal transfers. See that courier over there? He's moving money from one code to another. Maybe because it's something's been recorded in the wrong place. Miscoded finance call it. Or perhaps expenditure codes are being combined. Dunno. There's lots of reasons. And that little courier's called a journal transfer. It's a record of what's gone from one financial code to another, when and why. It helps the accountants keep tabs on things and allows them to make sure that everything's in the right place. They go mad filling them in at year end to get everything in the right place. Remember, we need to be able to compare one year's figure with another on the same basis. Apples with apples, pears with pears. Now, you may get one service within a council providing a one-off service to another. For example, you may get the maintenance department fixing a window at the depot. The maintenance department doesn't want to pay for the window materials, and it doesn't want to pick up the cost of one of its team spending time fixing a depot's window. It's only right, therefore, that the depot pays for it so that the true cost of running the depot is shown. The maintenance people will organise a recharge. In lots of councils, this is done by the accountants using a journal transfer. Well, that's just about it. I hope you've enjoyed the tour around the world of finance and accountancy lingo. Next stop, an overview of how the public sector works. Cheers! Industrial unit. All depends how